In the 1600s, the Dutch East India Company needed to fund its incredibly expensive global trade voyages. To do this, they turned to private citizens, offering them a chance to invest money in exchange for a share of the ship's future profits. This simple idea, born out of necessity in coffee houses and shipping ports, was the unintentional invention of the world's very first stock market. Since then, the market has evolved into a complex global system, but its core purpose remains the same: connecting companies with investors to fund growth. So, how does this modern, complex system actually work for companies and for you? Imagine a new, promising coffee company decides it's time to expand. To raise money, it will advertise itself to large investors. If they believe in the company's potential, these big investors will sponsor its initial public offering, or IPO. This is the moment the company launches onto the public market, where any individual who thinks the business could be profitable can buy a stock. Buying a stock, or a share, makes you a partial owner of that business. Your investment helps the company grow, maybe by opening new stores or developing new products. As the company becomes more successful, more people may see its potential and want to buy its stocks. This increase in demand drives the price of the stock higher. For those who already own the stock, its value increases. For the company, this rising interest not only funds new projects but also boosts its overall market value, showing how many people are willing to bet on its success. However, the reverse can also happen. If the company starts to seem less profitable, perhaps due to bad publicity, a change in leadership, or shifting market forces like the rising cost of coffee beans, investors might start to worry. If they believe their stock's value will decline, they will sell their shares to lock in a profit before the price drops further. As more stocks are sold, the demand goes down, and so does the stock price, taking the company's market value down with it. This seesaw of supply and demand, fueled by everything from economic data to human confidence, is what causes the day-to-day fluctuations in the market. In the past, this world was reserved for the rich and powerful. But today, the stock market is more accessible than ever. With the internet, everyday investors can research and buy stocks in the exact same companies as the largest investment firms. By educating yourself on how this system works, you too can support the businesses you believe in and work towards your own financial goals. The first step is getting invested.